A very good afternoon to you all. Sanjeev Singhal, Central Council member and the Chairman, Auditing and Assurance Standard Board and Chairman, Sustainability Reporting Standard Board. I, on my behalf and on behalf of my Vice Chairman, CA Vishal Doshi ji, welcome you to the 66th program of the AASB for this council year. Friends, this year we have taken the task of taking the learning of the auditing related matters to the doorstep of every member. More than 80,000 members have already joined our various programs, and these programs have been held both in the physical as well as in the on the virtual mode. And we have covered all auditing standards. We have covered CARO. We have covered the revised Schedule 3 additional requirement. We have covered element-wise financial statements, how to do audit of say PPE, how to do audit of intangible assets, leases, etc., related party disclosures. We have in the last program we have also covered special audit considerations for the non-corporate entities. Today we have come up with yet another topic. Today's topic is audit considerations for disclosure of accounting policies, estimates, and assumptions. And we sincerely hope that our members are taking the benefit of these seminars as well as the webinars. The seminars are held in physical mode, and the webinars, of course, anyone can join from anywhere in the globe. Friends, today we have a very esteemed speaker, CA Vijay Manyar, who has 35-year+ of post-qualification experience. And currently, he is an advisor and a mentor to a large accounting and consulting firm. And prior to that, also, he has been a partner in a large Indian firm, Indian Chartered Accountant firm. He has also been a special invitee on Accounting Standard Board of ICI for 2 years. He's been a member of Accounting and Auditing Committee of BCAS for more than 15 years, and he's a regular speaker at various forums. He's contributed extensively to ICI in the form of his contribution to the guidance note on Division 1, 2, and 3 of the revised Schedule 6, as well as the guidance note on revised Schedule 6 issued by ICAI. We welcome you, Vijay Bhai, and our participants are really looking forward to your deliberation. And friends, I have the great pleasure of mentioning that today's keynote speaker is, we, we call her Kemisha Ben. So Kemisha ji is a Central Council member. She's in the third term. Experience. Kemisha Ben is the chairperson of the PDC committee, the most important committee of the institute, which takes care of the professional development matters of the members. She has been the chairperson of the Ethical Standards Board. She is also currently the chairperson of the Committee on Public and Government Financial Management, and currently she is the vice chairperson of the Ethical Standard Board. She is an independent director of Ujjain Smart City Limited and a nominated member on the Madhya Pradesh Cooperative Audit Board. She is a technical advisor on the ISBA and a nominated member on Committee on Government and Public Sector Enterprises for SAFA. As I said today, currently she is serving her third term in the Central Council, and she has contributed extensively when she was in the CIRC Regional Council as well. She has been the chairperson, vice chairperson, and convener of many committees and groups of the institute. And she's also been the first women chairperson of Indore branch of CIRC and the first women chairperson of CIRC, first women chairperson of board studies of ICI, and during her tenure as chairperson in Indore branch, begged the award for the best branch award, and CIRC received the award for highly region. And her contribution, as I see on a day-to-day basis in the council, is immense. She comes with a very sharp point of view, and her thoughts are pretty clear on the subjects of her specialization and interest. So thank you, Kemisha Ben, for taking out time. I know that you're not fully recovered, but still you've agreed to be a keynote speaker. We welcome you, and we would like you to guide our members with your keynote address, and then we'll move on to Vijay Manyarji. Over to you, Commissioner.
Thank you, Sanjeev ji, for kind introduction. Greetings to one and all present here today. Chairman of the Auditing and Assurance Standard Board, CA Dr. Sanjeev Kumar Singhal ji. In absentia, CA Vishal Doshi ji, Vice Chairman AASB. Our guest speaker, CA Vijay Manyar ji, dear viewers. I cannot stop myself to congratulate Chairman AASB specifically. I would say that first I would like to congratulate for the recent notification regarding social stock exchange regulation in which you chaired Sustainable Reporting Standard Board of ICI and contributed immensely. And I was only I will say that I have taken only small responsibility that particular projects. But this is the milestone for ICI also, and in sense of professional opportunity also. So just I would also request Sanjeev, because in sense of professional opportunity also, there is a new professional opportunities in areas will open up for our chartered accountants. And I would also like to congratulate being a AASB chairman and your entire team for the release of the CARO 20 guidance note for the constitution of expert panel for addressing queries relating to statutory audits and other auditing aspects, and so many publications, and specifically what you have mentioned regarding webinars. So that learning series. So I would like to congratulate entire team of AASB under your leadership that you have done under this board. And so today's topic, audit considerations, disclosure of accounting policies, estimates and assumption, is of much technical importance. Being the PDC chairperson and regularly being in meetings with the various regulatory authorities, I can say with confidence that the regulator of our country, like the SEBI, RBI, CAG, NAFRA, CBDT, State ROC1, CBC, etc., are being vigilant about reviewing the financial statements and monitoring the reporting done by chartered accountant therein. And they have been sending these various reports, observation to the ICI as well, just for information of our members, because I'm also heading PDC. So we are receiving comments from various regulator on regular basis. And now even CAG is also in the process of introducing qualitative measurement criteria apart from the quantitative measurement criteria of CA firms. So that is also certain new development side from C&AG. And even with RBI also, because Sanjeev, you are aware about that regarding bank audit, certain observation, RBI also regularly sending us. And AASB is also part of that roundtable meetings and conferences. So we can also plan regarding that observations related to audit, specifically Companies Act, Banking Regulation Act and impact related to auditing aspects. So that is also certain development being PDC chairperson. And generally for learning purpose, I would say, very important technical learning is very important if you are practicing audit and assurance services. And as a CP requirement, so it is therefore becomes imperative enough to have 4 CP structured CP mandatory hours, auditing and ethical standards. So I would say that be it structured or unstructured, to keep our professional at par in terms of the competitive knowledge and technical skills. That is it is very important in day-to-day practice also. So I would suggest specifically to our members, please take benefit of all technical material of institute. We have also digital learning hub also, where even AASB and other technical board already uploaded technical material, lectures, and even webinar. I think Sanjeev is available on digital learning hub. So member can take benefit of that also. And specifically, apart from our publication of AASB, readily available checklist, formats, and certain technical materials and certificate formats are also excellent publication. I mean, we have. So member can easily download that publication, and they on desktop, they can make folder of that and they can use in day-to-day practice also. And one important publications in every seminar, generally, I used to mention about that Financial Reporting Review Board 3 publication that is related to accounting Standard Volume 1 to compliances related to accounting standard, and third one is related to India's study on compliance of financial reporting, that is Volume 3. And for the purpose of saying, I updated therein, just I'm quoting certain relevant para for today's topic from the said study on compliance on financial reporting Volume 3. Para 24, all significant accounting policies adopted in the preparation and presentation of financial statement should be disclosed. So what is the part of non-compliances? There is 77% non-compliance related to this para. In that particular analysis structured in our publication, it has been mentioned. Para 26, the financial statement should disclose the accounting policies adopted in measuring inventories, including the cost formula used, 45% non-compliances. One important related to inventory, because in case of tax audit also that is very important, inventory should be valued at lower of cost and net realizable value. So that is also certain 27% non-compliance related to this para. So as you all know that many times of the financial statement are based on the various forecast and prediction by the management in terms of accounting policies, estimates, and the underlying accounting assumptions. So as an auditor, we have a responsibility towards ensuring that these policies, estimates, and assumptions computed on a fair and reasonable basis and disclosed properly in the financial statement of the entity. And we should maintain in the form of documentation also regarding our meetings and conversation with management. So generally these policies, estimates, and assumptions form a part of the basis of preparation of financial statement, and therefore we can realize the importance of these during the course of our audit and in our practice. So with this, I will not take much time because we have with us Vijayji also, our speaker. So just I would suggest that he ready for next season of audit, whether related to tax audit, statutory audit, with all documentation and technical updates. With this being said, I would like to conclude my keynote address, and again over to our chairman.
Thank you very much, Kemisha ji, and thanks for your compliments on the social stock exchange, which has been notified yesterday. And ICI has been given a very big role of being the SRO of the social auditors. And we will leave no stone unturned to come up to the expectations of the Security Exchange Board of India. The work on social audit standard is already in progress. And by 15th of September of this year, we will come out with all the social audit standards. And your contribution in terms of formulating the code of conduct for the social auditor was of immense help. Thank you so much. With this, we now move to the technical session, which will be led by our esteemed member, CA Vijay Manyar. Over to you, Vijay bhai.
Am I right? Yeah. Hello. So chairman of AASB and the Sustainability Board, Dr. Sanjeev Singhal, and my dear friend, chairperson of PDC, Kemisha madam, other seniors who are attending this meeting, and friends. It gives me great pleasure to be on this platform and share my views on some of the very difficult and very theoretical topics. But before saying so, I must first congratulate Dr. Singhal for conducting this is 66th webinar. This is mind-boggling. And what I understand is it does not have CPA hours. So all those who are attending out of interest. I was actually wondering, today we are in the, it's a midweek. It's 31st July is the, tax filing date. And on the top of it, it's post-lunch session, and that too on auditing. So, it's a perfect recipe for just, keeping on the, video or getting connected without a video and doing some other work or having a nice nap, because it's just post this. And auditing has been, it's been considered as a very dull topic. We normally roll up our sleeve when client has some or the other accounting issues. We burn midnight oil. However, when it comes to auditing, which is what protects us, if there is a wrong accounting, it may or may not protect us. But if we have done the right auditing, it definitely protects us. However, I've seen as a profession, we are less concerned or bothered about our safety, our security, and we are more concerned about how do we provide solution to the client. But having said so, this 66th, webinar with, if there is a large attendance and people are genuinely interested in understanding, I really appreciate. And, it's been a discovery for me. Coming to my, topic. See, these are the topics now. Normally, when we do audit, we are more focused, and we normally focus, I've seen over the period, is on sales, on purchases, on inventory, on fixed assets, on other expenses. However, the focus on the estimates is something, we need to do, because we take it for granted. This estimates is not our responsibility. It is management's responsibility. And we take it on the file as what are the estimates, what are the fair values. And, we don't, do proper diligence. However, my experience is that maximum discussion happen around the judgments and estimates about the accounting policies, whether it has been disclosed appropriately, and whether it has been, what has been disclosed is followed. Because, I've seen, when reviewing as a, client, where the accounting policy is one thing, but actual implementation is something else. Reason being, because it's all accounting policy is only copy pasted from the previous year. Nobody reads it, but the auditing is done based on the practices. However, these two are so important, because as rightly, discussed, if accounting policy is not disclosed, we need to disclose all the accounting policies, and we'll deal with it. So all the significant accounting policies we need to disclose, number one. And number two is, we need to follow what is discussed. And above all, I'm assuming that all these accounting policies and what we are following is in accordance with the accounting standards. Having said so, let me start with accounting estimate. Keeping in mind the topic, which is, as I said, it's little theoretical and dull. What I've tried to do is, I've taken some 8-10 examples just to drive home why and what is important and what we should be doing. And that is where, I thought, rather than giving any theoretical knowledge, it is important that we understand practically from the published financial statements what is the importance of this accounting estimate. Why this accounting estimate, if you were to say, and if you go back to both basic, ultimately everything is cash converted into cash. So in the long term, as they say, and everybody is dead, as in the long term, everything is cash. However, since we have these cutoffs, saying that, we need to prepare a financial statement as on a particular date, which is say quarter, half year, year, we need to make some judgments and estimates. And hence, it is important that those judgments and estimates are backed by proper data, are reasonable, are consistent, and in compliance with the regulatory standards. And as auditors, we should have uh, uh, we should obtain sufficient appropriate evidence, because each judgment's estimates are relevant in terms of the framework. In fact, as a practice, we should have one section in our in our file where we should say that what are the significant judgments and estimates made by the management. We should list down those judgments and estimates. Then we should say that what is the basis on which management has made those judgments and estimates, and what we have audited, how we have got the comfort that these judgments and estimates are reasonable, consistently applied, and are in accordance with the framework. Now, each framework will have a different way of dealing with it, and let me give you a couple of examples to drive home the point. So for example, say in Indian GAAP, when we say fair value is willing buyer and willing seller. So that is how the fair value is determined. And it's a separate topic by itself, but I'm just trying to give some differences to drive home why the reporting framework is important. So Indian GAAP says one thing. Ind AS, there is a standard Ind AS 113 on fair value, which describes the way in which this needs to be done. It is talking about the exit price. So it's not a fair value, but it is an exit price. So if I'm a seller, at what value I can exit? And then what are the other, even if observable market inputs are there, can I make adjustments? To what extent it can be made adjustments if there are not observable inputs are available? So for example, if there is a market price readily available, then that's a market price. What adjustments can be made to the market price if there is illiquidity of that asset, or that I have such a large quantity that it cannot be sold in the marketplace? So there are different guidances which is available in the standard. Number two, the fair value is dependent on a situation to situation basis, right? So for a person, asset needs to be fair value. So if I'm holding some securities for trading, then I will hold it for mark to market. Whereas under Indian GAAP, I will do it at a lower of cost or net realizable value, unless there is a regulatory requirement. So this fair value framework also changes based on then depending on the kind of asset and liability. If we have investment, now that investment, the mark to market, the standard will say we have to mark to market, so we need to fair value, whether that will go to P&L or whether it will go to equity. So what can be fair valued or not is dependent on the framework. Secondly, after having fair value, whether it will go to P&L or it will go to equity directly is also dependent on the asset and liability. So as I said, fair value, one has to look at the reporting framework, look at the guidance in the reporting framework. Indian GAAP does not provide much guidance. Ind AS provides that guidance. So one has to look that guidance. Even for implementing Indian GAAP, if there is no guidance other than this, one can take references from the Ind AS guidances if there is no other guidance which is available. All accounting estimates, so as auditor, we need to look at all the accounting estimates and judgments, which are, as I'm saying, as I said, and we need to not only ensure that those are in line with, so consistently deployed, the judgments are reasonable, the fair value is as per the framework, but also there is a disclosure as may be required by the regulatory framework. The idea of fair value is not that, it has to be exactly the same amount when it is sold. So for example, if there is a item which has been fair valued, or if there is a judgment which has been made on say provision for debtors or inventory, or some other provision, say sales scheme, it is not that the actual result is the same. It does not, if there is a difference in the actual result then the estimate, it is not that there is a mistake. However, if management had that kind of information available, but that information was not taken into consideration, then it could be considered as a mistake. So the idea is, I'm repeating, it is, ultimately estimate is an estimate. Fair value is a fair value. That does not mean that the realization will be actually at that value. However, if the realization is different than the actual, one has to evaluate what is the difference. Was there, all the information which was required was taken into consideration while doing the original estimate. Some of the estimates, which we'll deal with it is, this is in the, a percentage of completion method, correct? Or that, acquisition business combinations of assets and liabilities acquired and the fair valuation of this, or the impairment evaluation of investments or any asset or a business, contingent liability evaluation. All these are significant judgments because, contingent liability will, whether it is possible, probable, remote. If it is possible, then proper disclosure has been made. If it is probable, adequate provision has been made. If it is considered remote, the reason and the basis why it has been considered. I'm talking about all this as a, significant litigation. Sales return schemes, because, the scheme may overlap one accounting period into another accounting period. So if there are any open schemes which are there, or that, we have, the company has given option to the customer to return the goods, then this is an estimate, right? And so on and so forth. We'll see all this, in terms of the example. The idea is that even the depreciation. Now I'd seen, if there is a statutory rate applied, then we don't question the depreciation, but ultimately depreciation is an estimate. What is the useful life of this? And if it is a significant, amount of asset, the useful life is important, because ultimately the, if it is, 15 years or 20 years, it makes a difference, the 5 years depreciation. This is an estimate which we need to, evaluate. Provision for doubtful debts, warranty provision. If the company has sold any goods or services with a warranty provision, then whether the warranty provision is adequate or not. So I'm saying these are the, we come across, and I've listed down some of them or most of them as a part of judgments and estimates what we make which management make, and we audit those judgments and estimates. Why I'm saying this is important is, and this is where, I've quoted some of the companies. If if there is any item which is of significance during the course of audit, which auditors encountered, that needs to be disclosed as a part of key audit matters. Key audit matters are items which we discuss, with those charged with governance. That means, management or the audit committee, as the case may be. But in case of listed companies, we also put as this is, communicative value, because there was a discussion which was happening as to audit report is true and fair, not true and fair, and some, qualification or emphasis, but it does not say much about what was there during the audit, what was the significant matter which was there during the course of audit, and why it was significant, and why this, how this was addressed by the auditor. And hence I've picked up few of those significant matters which are reported. These are all from the published financials, which are reported. And it says that why this item was considered as significant and what was the auditing procedure. Why will say, so I will run through it. Why will say is this is talking about judgments and estimates. I have not picked up those other than judgments and estimates and fair value. So judgments and estimate will talk. So why this is considered as a key audit matter and how this has been addressed. Because we as auditor, when we audit any judgments and estimates and fair value, we need to ensure, and then at the end we'll summarize as to what all these samples which we have discussed, what is it as auditors for us to take away. So first of all, POCM, percentage of completion method. Now, why this is critical? Because this directly impacts the revenue, right? Because the revenue is based on the estimate, and hence, this is what the auditors have mentioned is, and this is from 2021 audit report, is the significant portion of company's business is from construction contracts where revenue is recognized under POCM. This is based on percentage of cost incurred to date compared to total estimated cost. And we identified this as a key audit matter since now it is important. There is inherent risk and presumed risk of fraud. Revenue, it's a presumed risk, in our audit, it's a presumed risk that revenue is a fraud risk unless one can demonstrate that why one is not considered revenue as the fraud risk. So there is inherent risk and the presumed fraud risk around existence and valuation of revenue recognized considering the customized and complex nature of these contracts and significant inputs of IT system. So it is complex. Number two, application of 115 revenue from contracts with customer is complex and involves number of significant judgments and estimates. It's related to identifying performance obligations, transaction price, estimating the balance cost to complete the contract, and the determining the percentage of completion. So this is mentioned very critical, and this is one of the most critical, judgment and estimates which any POCM companies make is what is balance cost to complete. So two things. One is whether all the costs are charged to the contract for which the cost is incurred, which I am assuming it is charged. But what is the balance cost? Because the judgment which has been made is what is the balance cost to complete. Depending on balance cost to complete, percentage is lower, the revenue recognized is higher. If revenue recognized is higher, then it is possible that some incentive may be there, some targets of the management may be there, which the current management may take or the current team may take. But if the balance cost to complete is higher, then the revenue recognized is lower, and hence this is very important. Now, what does auditor has done? How this was addressed? So, auditor obtained the understanding of the company's system, process, policies for construction contracts. So, the auditor first obtained the company's system, policies, and procedures. Then obtain understanding of business process specific to construction contracts from its initiation through the presentation in the standalone financial statements and tested the operative effectiveness, right? So it is saying initiation through the presentation, and that is also we need to ensure. This is what we discuss, the disclosure. Then evaluate company's estimation and assumptions based on the risk-based selection of sample contracts. Our audit procedures covered, among other things, the test of the contracts, including terms and conditions, termination rights, penalties for delays, and breach of contract, as well as liquidated damages. Because, it is inherent that if there is a delay, there could be penalties. If there is a breach of contract, there could be liquidated damages. Then evaluated revenue recognized for the selected project, analyze billable revenue and cost of sales to be recognized in the statement of profit and loss to the extent of progress towards completion, and perform inquiries with the development of the budgeted cost deviation plan, actual cost, estimated cost to complete, and company's assessment of probability to contract risk. So why this is important, which is they've said it is because of judgments, estimates, and what procedures auditors have. We'll learn through this couple of more and to evaluate and say at the end, as I said, we'll summarize what are the learning from this and what we should be doing as the auditor. So Siemens is an infra company, as you know. Now this is, I'm talking about Infosys. This is from March 22. So it is not only the infra or the construction companies have POCM, even the service companies have POCM. So for example, we are most of the time we are on a fixed price contract. So our audit fees are by and large fixed. One can discuss overruns at a later date, but by and large it is fixed. Now, if we as the auditor were to move to percentage completion, how it can be done? Correct. So balance cost to complete. So 31st of March, when we close our financial statements, lot of work for the client has been done, but the balance work is pending. How do we estimate the balance work? What is the cost of the balance work if we were to come to accrual basis of accounting? And this is similar, this we'll deal with it in this Infosys. So it says Infosys that fixed price maintenance revenues record. Okay. Let me, I'll discuss only, read only what is relevant. Revenue from other fixed price, fixed frame contracts where performance obligations are satisfied over time is recognized using POCM. Use of percentage completion method requires company to determine actual efforts or cost, similar to Siemens, expended to date as a proportion of the estimated total efforts or cost to be incurred. So it is the actual cost, like our case, we estimate the actual cost before the audit. So estimated total cost and cost incurred. Efforts or cost expended have been used as a measure of progress toward completion, as there is direct relationship and input and between input and productivity. The estimation of total efforts or cost involves significant judgment and is assessed throughout the period of the contract to reflect the changes based on the latest available information. Provision for estimated losses, if any, on incomplete contract are recorded in the period in which such losses become probable. And it says we identified this estimated total efforts or cost to complete fixed price contract measured as using percentage of completion as a key audit matter, as the estimation of total efforts or cost involves significant judgment in assessed throughout the period of contract to reflect changes based on the latest available information. So this is very important. And this estimate has a high inherent degree uncertainty and requires consideration of progress of the contract efforts or cost incurred to date and estimates of cost or cost required to complete the remaining contract performance obligations over the terms of the contract. So idea is that what is the budget, how much has been incurred, what is the balance cost? That is most important, because what has been done is done, but what is the balance cost based on which the revenue is recognized, and what procedures auditors have done. So we tested the effectiveness of the control relating to recording of efforts or cost incurred and estimation of efforts or cost required to complete the remaining contract. Correct? Because what is incurred, has it been charged to the right account, right charge, right contract? Because that determines the percentage completion of that contract and the cost required to complete the remaining contract. Access and application access and application controls pertaining to time recording, allocation, budgeting system, which prevents unauthorized changes to recording efforts required. Because whether the efforts, actual cost incurred efforts are charged to the right contract is important. Then it says we selected sample of fixed price contract with customer measured using POCM and performed the following. Evaluated management's ability to reasonably estimate the progress towards satisfying the performance obligation by comparing actual efforts or cost incurred to prior year's estimate of efforts or cost budgeted for performance obligation that have been fulfilled. We look at the past. Any judgments estimate, as I mentioned, it's not that, that will result into actual, but to evaluate what has been the management basis at past is very important. Hence, it is rightly, disclosed. Compare the efforts or cost incurred with the company's estimates of efforts and cost incurred to date to identify significant variation. Because there is variation, but one has to evaluate. Suddenly COVID comes, the estimate goes for a toss, right? Suddenly some event happen, the estimate goes for a toss. So whether those variations have been considered appropriately in estimating the remaining cost or efforts to complete the contract, and tested the estimate for consistency with the status of delivery of milestone and customer acceptance and sign off from customer to identify possible delays in achieving the milestone, which requires changes in estimated efforts or efforts to complete the remaining performance obligation. So here also, like Siemens, cost, whether cost has been charged to proper account, it's a fact, it's a control, but the estimate is the balance cost to complete. So that was on the revenue, I thought was important. Now let's litigation. One of the significant judgments and estimates required. So Ultratech Cement, I'm reading this. The company operates in various states within India and exposed to different central and state laws, regulation and interpretation thereof. Due to complex regulatory environment, there is inherent risk of litigation and claims. Consequently, provision and contingent liability disclosures may arise from indirect tax proceedings, legal proceedings, including regulatory and other government proceedings, as well as investigations by authorities and commercial banks. The company applies, why this is important, company applies significant judgments in estimating the likelihood of future outcome in each case, right? So judgment is coming, significant judgment. Auditors have brought out in the key audit matter. So significant matter, for the auditor in determining the provision and or disclosure. It says it's not that it's saying provision or disclosure. Resolution of tax and legal proceedings may span over a multiple years due to highly complex nature and magnitude of the legal matter involved, and may involve protracted negotiations and litigation. So it's not only the outcome of the litigation, but as and when it is resolved, when it will get resolved, and if it is against the company, then what is the likely time frame? Everything is uncertain. These estimates could change significantly over time. Because of this, it's not that, as I said, whatever estimates are done, that will be actual. It could change significantly. And then it says, given inherent complexity and magnitude of potential exposure and judgment necessary to estimate the amount of provision required or determine required disclosure, this is the key matter, right? Now let's come here. What is the auditing procedure? We understood the process, evaluated the design and implementation of control. So idea is, it's not possible to do it. So that is one of the things, as I said, we'll discuss at the end, how do we consolidate this list. So we understood the process, evaluated the design and implementation of control, and tested the operating effectiveness of company's control over recording and reassessment of uncertain legal positions claims, including claims receivable and contingent liabilities. Because the company has the process, understand the process, whether the design of the process is right, whether it is operating effectively. We have gained an understanding of outstanding litigation against the company from company's in-house counsel or other key managerial person who have knowledge of this matter. It's a completeness, right? Because litigation is off balance sheet item. We would not know the completeness of litigation, and hence it is important to have discuss with the in-house legal counsel. We read the correspondence between the company and various indirect legal authorities, and legal opinions of external legal advisors were applicable for significant matters. We tested the company's litigation and claims by examining on a sample basis company's legal expenses. This is important, because any estimates and judgments, and this is I'm just generalizing from this, if there are some other, actual expense or income based on this, one has to, we should be skeptical. Was it anything relating to the estimate, which is a significant estimate? I'm only talking about the significant one. Then we have challenged the company's estimate of a possible outcome of the disputed cases based on applicable indirect tax laws and legal precedents by involving our tax specialist. We have assessed the adequacy of company's disclosure in respect of contingent liabilities for, so whatever provision, possible, probable, remote, everything, this is a significant judgments and estimates. So first we saw about revenue. This is the litigation. This is the derivative, right? The derivative is, because there are all complex valuations which, come into play. And in case of banks and NBFCs, specifically when there are complex derivatives, it is a, it can be a very have significant impact on the financial statements, even for the companies. Like I recollect, couple of my clients few years back had changed their domestic, they could not borrow from overseas. So there was a product which was available saying that, one can convert the rupee borrowing through derivative into foreign borrowing. And then also do the interest rate swap based on this. And I saw, that item of complex derivative was one of the highest item in the balance sheet, whether it was on the income side or on the expense. But that was a one-off. Here, this is a bank, NBFC would have a huge such this. So, so that is where, so this is key audit matter. Why? I'm just trying to read what auditing procedure has been done. As I said, I'm not getting into this, but we said we included our valuation expert as a part of our audit team. It's not that, we as auditors can have all the experts, right? So earlier there was a tax expert. There could be legal experts we can consult. We can consult valuation experts that we can see later. But I'm saying here, this is a for valuation expert for the derivatives as a part of our audit to obtain an understanding, evaluate the design and test the operating effectiveness of the key controls over the valuation process, including independent price verification, perform model governance, and blah, blah, blah. So, and the valuation experts will look at it, whether it is in accordance with the RBI regulation, whether it is reasonable. So this is important. Again, why so? Because this is a significant judgments and estimate. It arose during the course of audit, and auditor thought it appropriate to report it by way of key audit method. This is little longer, but now this is again coming to sales, and that too about discounts and rebates. So what happens, lot of times there is a scheme which the company runs of giving additional discounts or rebates to the customer, and this can overlap between the accounting period, and hence such judgments and estimates are required. So it says certain accounts, discounts and rebates for goods sold are only finalized when precise amounts are known, and revenue therefore includes an estimate of variable consideration, because this discounts, rebates are adjusted towards revenue, and revenue, as we discussed earlier, is a inherent fraud risk. And this is a significant judgment. If you look at, do Google, you will see some or the other companies would have some irregularities around discounts, rebate, returns, or, POCM accounting, just to ensure that their profits are protected, their revenues are protected, or just to take higher incentives, bonus. So it was based on the mala fide, and hence for any adjustments to revenue, it is important that we do additional procedures. The variable consideration represents the portion of discounts and rebates that are not directly reduced on the invoice and involves estimation by the company in recognition and measurement of such rebates. This includes establishing an accrual at the year end, particularly in an arrangement with customer involving varying terms, which are based on annual contracts or shorter term arrangements. In addition, the value and timing of the promotion of the product varies from period to period, and activity can spend beyond the year. The unsettled portion of the variable consideration results in discounts and rebate due to customer at the year end. Again, what did auditor do? Understand the process followed by the company. All the auditors, that's where I'm saying this is one thing, is understand the process followed by the company. Evaluate the design and implementation of testing, the operating effectiveness of companies' IT general controls, key manual controls, application controls, companies' IT systems, including control over rebates, agreements, rebate payments, settlements, and companies' review. Again, everywhere, if you see, IT plays an important. We can't do audit, even the judgments and estimates. In case of large audits, we need IT. IT is a specialist. Inspecting on a sample basis key customer contracts based on so you do it on a key customer contracts, then perform substantive testing, then examining historical rebate accrual together with understanding of current year's development to form an expectation of rebate accrual as at the year end, and comparing this expectation against the actual rebate accrual completing. Okay, one more important thing. There is a management bias in terms of the estimates and judgments. Similarly, there could be auditor's bias, because what we should actually do is we should develop our own estimates, and specifically for this routine transaction where the data is available. So for sales discounts and rebates and all, provision for doubtful debts, we should develop our own expectation. The idea is that we develop the expectation and compare it with the management. Otherwise, we tend to agree with what management is done and, given the explanation, rather than evaluating and challenging ourselves as, is it the right? Because, it's ultimately judgments and estimates. Management may miss some areas to look at, and, whether it is certain or uncertain. And hence, we should, as auditors, we are expected to develop our own expectations, specifically in this kind of situation, and check the arithmetical accuracy, and do the subsequent event and all. So this is on discount and rebate. Now comes in again. So this is on impairment evaluation. So we saw revenue, we saw litigation, we saw discount schemes. Now this is the impairment. This is of DMart in March 21. It says company's investment amounting to so and so. The subsidiary commenced business buyback and has continued losses, which provides indicator for impairment. Management has used external specialists to support the recoverable amount of investment on fair value of equity shares after taking into consideration potential impact of COVID. This was a post-COVID and hence potential impact of COVID. We determine this as a key audit matter because of the judgmental factor involved in testing the impairment and significant carrying value of the investment. What is the audit procedure? We assess the company's valuation methodology applied in determining the fair value. Because earlier for derivative and this, there was a process, right? It's a routine process. Derivative is a routine process because regularly bank enters. The sales is a routine process, but here evaluation of a particular investment is not routine, and hence one has to look at it. It's a non-routine process. In making this assessment, we evaluated the objectivity and independence of the company specialist. It is important that if their company is expert, is that expert objective? Is that expert independent? So we need to do that auditing procedure when we rely on the company appointed expert. Then we involved our valuation expert to assist in evaluating the key inputs along with comparable transaction multiples of peers of the company available in public domain and the discount rate on multiples. So idea is, what is the basis? Ultimately, this it can be any basis. So what is the basis of evaluation and whether it is appropriate? So, and we obtained and read the financial statements and assess the disclosure. So idea is right from company's appointment to the disclosure. This is what procedures auditors have done. Again, this is this is also sales return and discount. This is of BBFRL March 21. It says revenue from contract with customer is account recognized so and so. In some cases, discounts estimated and accrued are offered on further sale of goods by the customer. Also, in some cases, company has a contract with customers which entices them right of return. As at the year end, the expected returns and discounts that have not yet been settled with the customer are estimated. Again, it falls into two accounting period. Estimating the amount of accrual as the year end is considered as key audit matter due to assumptions and judgments required by them. Again, judgments. What these auditors do? Assess company's accounting policy for recognition and measurement of net sales, including policy for recording returns. So first, evaluate what is the policy. Test the design and operating effectiveness of controls. Test the estimated returns discount with underlying documentation, because this was done in the past. Obtain understanding of management estimate of business impact of 19. That changes, right? Because this COVID came in March 21 or March 20, but this continued. So COVID import is important. Tested on sample basis, credit notes issued, and perform analytical procedures on returns and discounts, and held discussion with the management to understand the changes in the provisioning norms, additional provision made based on management assessments of market condition. Because it is not that it's same process, same policy changes, doesn't matter. Changing circumstances, it changes. And the disclosure. Bajaj Finance is a big one. Let me run through the key one, because this is ECL, and that is one of the most hotly discussed topics. So let me read, because it is 86% of the company's total asset. So it says significant judgment used in classifying these loan assets and applying appropriate measurement principles. ECL on such loan assets measured at amortized cost is critical in estimate involving greater level of management judgment. ECL, it's very complicated, difficult. Anybody, and specifically banks and NBFC, what is the model? So as a part of our risk assessment, we determine that ECL on such loans has high degree of estimation uncertainty with a potential range of reasonable outcomes for standalone financial statements. The elements of estimating ECL which involved increased level of audit focus are followed. And then it gives, why ECL is, difficult. So it gives all this. So this is all. And so I'm saying the importance of ECL, everybody knows. I'm just trying to highlight, but I'm saying what auditors have done is something which is important for us, because we, as auditors, needs to do those procedures which are relevant for the respective judgments and estimates. So here, in all other cases, we looked at the process, design, operating effectiveness. Here, it's a policy. So each estimate has a different procedure for us to document. So we have examined the policies approved by the board of directors of the company that articulate the objectives of managing each portfolio and their business model. We have also verified the methodology adopted for computation of ECL that addresses policies approved by the board of directors, procedures control for assessing the measuring credit risk on all lending exposure measured at amortized cost. Additionally, we have confirmed that adjustments to the output of the ECL model are consistent with the documented rationale and basis of such adjustment, and that the amount of adjustment have been approved. So the idea is, what is the policy? Whether that policy has been, applied in the manner, is that model appropriate? The IT controls around this are there. Then it says testing and design and operating effectiveness of the following: completeness and accuracy of exposure at default and classification thereof into different stages consistent with the definition. So in accordance with the policy approved. completeness and accuracy, appropriateness of the information used in the estimation of probabilities of default and loss given default for different stages depending on the nature of portfolio, accuracy in computation in estimating, including the reasonableness of the methodology used to determine macroeconomic overlays and adjustments to the output of, because ECL is very complicated. There are different risks. One is to factor in the country risk, the sector risk, the company risk, the customer risk, and all so on and so forth. So it's a very complex model. So idea is, what is the policy of the board? Is that policy in accordance, appropriate, design is right, whether this has been implemented accordingly. So this is all so on and so forth. The idea is this is on ECL. So provision for doubtful debts or ECL. This is one. Now, as a part of audit financial statements, the company has to also disclose what are the significant judgments and estimates and assumptions. I'm not saying anything. I'm just picked up things from the financial statements to drive home that what are the judgments and estimates, and then we have seen how this needs to be addressed. Correct. So I'll read only what is relevant. This is little more busier than the earlier. So it says so this is from Grasim March. This is Grasim March 21, not March 22. This is Grasim March. So it says judgment. So in the process of applying groups accounting policies, the management has made following judgments which have the most significant effect on the amounts recognized in the consolidated financial statement. Now you see any of the financial statements will have this particular caption on the judgments, but if management itself says, the company itself says that they have made significant judgments on certain aspect, can we ignore it? I'm saying this, we need to do it sooner as a part of audit than later. So classification of some companies as joint venture. So it says a subsidiary company holds either directly or through its subsidiary more than half of the equity shareholding of the following entities. However, as per shareholders agreement, the group needs to jointly decide whether other shareholders of the respective entity on certain relevant activities. Hence, this have been consolidated as per equity method. The idea is that company has more than 50% stake. However, this is not considered as a subsidiary, but as a joint venture. This is a judgment and estimate. Then estimate of certain uncertainties relating to global health, right? Because this also is an estimate which will have impact on the carrying values of assets and liabilities. So this is for March 21, and hence this is more relevant. It could also be relevant for March 22, but the company has considered the possible effects that may result from pandemic relating to COVID on the carrying amount of receivables, intangibles, investments, and other assets. In developing the assumptions relating to possible future uncertainties in the economic conditions because of this pandemic, the company has used internal and external source of information. The company has reviewed the assumptions used and based on the current estimates, expect the carrying amount of these assets will be recovered. So one has to understand what is the basis on which it has been done. Then again, useful life of plant, PP&E, and intangible assets. So it says, technical expertise along with historical and industry trends to determine the economic life of. This is a significant judgments and estimates. As I said, it's not, if it is statutory, that doesn't mean that our work is done. We need to determine whether it is statutory is the right rate, is the right way to arrive at the useful life. Then mines restoration obligations. So if there are some obligations, then in determining mines restoration obligations, assumptions and estimates are made in relation to discount rates, expected cost of mine restoration, and expected timing. Because any mine needs to be restored, Correct. One does not know when it will be done, what will be the cost, and how do we, if I'm to incur some cost at the end of 5 years or 10 years, there is a difference because the discounting is done, accordingly. Similarly, any defined benefit obligations, and specifically in case of a companies which has a decent payroll cost, the actuarial assumption is important, and this is, I will not dwell on this. Deferred tax and liabilities. Even here, and I've seen quite a few companies, auditors have given deferred tax asset as a key audit matter. So significant judgments, significant discussion. I've not quoted this. I thought this has quite a few judgments and estimates which we can discuss at one go. So deferred tax assets and liabilities. So pursuant to announcement of changes in the corporate tax regime, the company have an option to either opt for the new regime or continue to pay tax as per old tax, applicable tax structure together with other benefits available to the companies, including utilization of MAT credit available. This requires significant estimation in determining in which year the company would migrate, because company will definitely migrate into the new year. Correct. But when will company migrate? Company would migrate to new tax regime basis futures taxable profits, including impact of ongoing expansion plans and consequential utilization of available MAT credit. Accordingly, in accordance with Ind AS 12, deferred tax assets and liabilities are required to be measured at the rates that are expected to apply to the year when assets is realized or liabilities settled, based on tax rates that have been enacted or substantially enacted at the reporting period. Because when the company will move to the new tax regime, and if it is significant, then this becomes a significant. And as I said, quite a few company auditors have determined this as a key audit matters to be reported in the audit report. Remeasurement of provision and contingency, I will not get into it. Now, even ESOP, correct, because the group measures the cost of equity settled transaction with employees using Black-Scholes model to determine the fair value of the liability. Because ultimately, what is the fair value of liability that gets determined? There is a formal process which is there is a formal model which is available, which is Black-Scholes model. So it becomes easier because there is some guidance which is available, and then we rely on the expert, which is the actuary, to determine what is the charge. So Black-Scholes model to determine the fair value of the liability incurred on the grant date. Estimating the fair value for the share-based payment transaction requires determination of the most appropriation valuation model, which is dependent on the terms and conditions of the grant. This estimation also requires determination of the most appropriate inputs to valuation model, including the expected life of the share options, because share options may lapse, people may go, company may perform, so many will get ultimately will get exercised. Dividend yield and making assumptions about them. The assumptions and model used for estimating fair value share-based payment transactions are disclosed. So there is a disclosure. Similarly, if there is any disposal, companies decided to sell any of the asset or the business, then this gets fair value. So this is similar to similarly. So I will not get into this. Similarly, this is for the investments which we have seen. This is for the tangible and intangible assets. So, one has to evaluate at the end that is there any impairment, and if correct, and if there is an impairment, then what is the basis on which it is provided? If it is concluded it is not an impairment, there is no impairment, is that appropriate to conclude there is no impairment? So this is all on the impairment of non-current assets, non-financials, impairment of financial assets, including ECL model, which we have seen. Okay, here Fair valuation of intangibles. This is also one of the item which we discussed. The company used the income approach. Example, relief from royalty, multi-period, excess earning method, and incremental cash flows for value analysis of intangible assets. The method estimates the value of the future cash flows over the life of the intangible asset accruing to the company by virtue of the transaction. The resulting post-tax cash flows for each years are recognized at their present value using the weighted average cost of capital adjusted to the risk of achieving intangible assets projection. The idea is how it is fair value because this is the business combination. So business combination, so we have acquired this asset. So what is the value of this asset, right? What is how much is the cash flow we are going to get out of this? What is the advantage of this? So is there any incremental cash flow? What is the present value? What is the risk of achieving? And all this gets into the fair valuation. Similarly, fair valuation of tangible for land that is available for this, fair valuation of loan, fair value. So idea is that, as I said, everything is fair valuation. For fair valuation, there is a judgments, estimates, Ind AS has come in, which is more and more fair valuation. So idea is that fair valuation, the judgments, estimates, basis. Now, one has to be on the top of it as auditors. And this work, because it is possible to have management biases because of some incentive linked with it or otherwise. As I said, mala fide intention or ignorance. But we as auditors needs to be mindful of what are the different ways in which the fair valuation can be done. What are the judgments and estimates which has been made by the management? And are they consistent? Similarly, this is for Reliance. They also have some critical accounting judgments which they put it in their financial statements. So they have estimation of gas, oil, and reserves, decommissioning liability, similar to the earlier one what we saw. So there is a decommissioning liability. So there it was for the mine. This is for the oil wells and all. Impairment provisions, impairment of financial and non-financial assets, property, plant and equipment. So the useful life, ECL, so recoverability of trade receivable, deferred tax asset and liabilities, fair value measurement, pandemic. So the idea is, I'm, sorry for this wrong, but I want to emphasize, or re-emphasize, it is very, very important that we have a thorough understanding of what are the judgments and estimates made by the management. Where is the fair value required? What is the framework for the fair value? Whether it has been done as per the fair value, framework which is available. The judgments and estimates, are they in line? Are they being consistently deployed? It's not necessary. It has to be consistent. But if they are consistent, what is the past history of the management in meeting those judgments and estimates? And then document all this. So this is what is. So this is now procedures. So we discussed this, the requirement of applicable fund. So whichever is the framework, we need to do disclosures accordingly, fair value accordingly, which we discuss in days, Indian GAAP. If there is any regulatory, say RBI comes up with a requirement accordingly, according to that. How management identifies those transactions, events, and conditions that give rise for the need for accounting. Because this is what we need to understand. We know it based on what we are reading, based on this, but management should have that process of saying that these are the judgments and estimates, and how management makes those judgments and estimates. We saw all this. I'm saying this just to refresh that the method, whether what model, what is the method which has been used, how the management is ensuring that the method, the input, the model is appropriate. whether the management has in-house competency to do it, or the management is, engaged with the, experts, outside experts, the underlying assumptions, and whether there has been or ought to have been changed from the prior period for making this, if so, why. It's, as I said, it is not necessary one has to continue. One has to learn from the past and then start correcting the the judgments and estimates made. And whether and if so, how management has assessed the effect of estimation uncertain. Because ultimately, everything is uncertain. So there, how this has been considered by the management during the process. So this is what is the management. Now what we should do. Now I'll just summarize, based on what we discussed and what those companies auditors have reported. I'm just trying to summarize this because we have had this discussion. So first is evaluate the design of the control. Correct. So if it is a routine transaction, like we saw for sales, for ECL, right, returns, discount, POCM. So what is the design? So the company will have the process. So we have to read that process. Correct. Is that enough, segregation of responsibility? Who is making the, this estimate? Is the one, so suppose, is the salesperson only saying that how much is the discount and returns will come in, or is it somebody independent of the salesperson? Because salesperson technically is, one can take input, but if it is a normal routine process, then there has to be, all these judgments and estimates should be made by somebody other than the person who is actually doing the transaction. So what is the design? We need to test those controls, correct? So test those controls, whether those controls are manual, IT dependent, IT. Very, very important. If this, we need to have experts in the team who understands this. And mind you, today's companies are having very sophisticated IT system. We should gear up to have those experts in the team. Otherwise, everything, all the routine transactions will be fine. The company can play around only in the judgments and estimates and manage their profits. I'm not saying would do it, but I'm saying we need to keep that in mind. IT has become so much ingrained that we as auditors should upgrade our skills as far as the IT is concerned. Evaluate the degree of estimation uncertainty associated with an accounting estimate. So what is the degree of uncertainty? If in the past for the routine transaction, if it is in the past management judgment is fine, there is no changes. We have discussion, it's a routine. But if it is some one-off valuation, which is of a significant item, and there are no observable input available, but only unobservable inputs are there, then estimation uncertainty is higher. Determine whether in auditor's judgment, any of those accounting estimates that have been identified as having high estimation certainty to give rise to significant risk. Right? If it is a significant risk, higher the risk, higher is the procedure. So we need to do, because significant risk has higher impact on financial statements, higher impact on the profits or the cash flows, future cash flows, or the position of the state of affairs of the company as on that. So if something is high significant risk, we need to do more procedures. Determine the sample size based on nature of control and outcome of testing. So in case of a routine transaction, the sample size could be based on the outcome of the controls. If it is one of, one has to determine depending on, so as a litigation, for somebody it could be, few litigations, so one can review it. If there is a, like Ultratech, they have a list as this has been disclosed, then there one can do based on the sampling. Develop expectations specifically for routine transaction. This is what I mentioned. We can rely because we get biased by what management say and we tend to forget, but we should develop our own expectation based on our understanding. We should develop that kind of understanding of the business, of the way company does the business based on the past trend and evaluate what should be the likely amount and compare the results with the management estimate. Identify and analyze the difference. Evaluate if there is any management bias. It's very important because any judgments and estimates, management is normally biased. Not normally, means I would not be appropriate to say, but management may be biased to go by certain view. It has to be unbiased because it is judgments and estimate. More so, we need to document. So we need to ensure that there is no management bias. There is consistency of assumptions, and if change, then reason and basis thereof. So if there is no bar, I'm repeating. So everything will change. The basis, why change? The basis, if it is reasonable, it is fine. Whole discussion with the management and those charged with the governance. We should have this because these are significant matters. We should have discussion with the management, those charged with governance, audit committee. Obtain management representation. Any judgments and estimates, we need to have management representation very categorically why management believes this is the right way, and then conclude documentation. So conclude means all this needs to be documented. The idea is that based on all this is what I thought appropriate. The standard is too long, but I said, let me put it in one slide as to what is it that is required, what is expected based on the key judgments and estimates and the fair value what we saw. And management bias also we looked at. The auditor shall review the judgments and decision made by the management in making the accounting estimate to identify whether there are indicators of possible management biases. Indicators of possible management biases do not themselves constitute misstatement for the, because it's more of sentiments, the way management is thinking. Management may not have looked at all the areas which could impact the judgments and estimates. So it is, don't conclude that it's a possible misstatement or there is a bias. It is possible there could be errors, genuine errors, which management would make changes, but we should be on the top of it. Disclosures. So we should all the disclosures. Now all the disclosures would be as per the accounting standard or the regulatory requirement or anything which enables the users of the financial statement to understand and interpret. So all the disclosures needs to be there. Written representation, which we have seen in the documentation. I think it's very important that we document the reasonableness of estimate, the reason why we have concluded what we agree. It's a lot of times there is a range. So for example, company has investment in another company and it has a value. Now management may come up with a value, we can come up with a value. The idea is it should be within the range. That range could be between 5, 10%, 15, 20%. It could be different. It's not that because there is no rocket science to say that this is the value, this is the liability one has to provide. It has to be in the range. So long as the basis is appropriate, the assumptions are reasonable. The outcome, if there is a difference of say 10, 15%, that is fine. It's not that we are looking for that exact number to align with the management. So those differences, I think we can live with it. So this is on estimates. Any questions anybody wants to ask? How do you, I do not know. Or we go to the next.
Sir, we will take questions at the end, sir.
Okay. Okay.
Yes, yes.
Yeah. So what are so what are accounting policies? So first of all, let us understand, because not everything what we do would be given by or would be there in the accounting standards first. So there are specific principles, basis, convention, rules, practices. There are a lot of things which can come by the practice, which are applied in preparing and presenting the financial statements. In days 8, I'm not getting into too much into Indian GAAP because I think we all need to graduate to Ind AS, and hence I've not focused on this, but I think the principle and the application of this will be applied in Indian GAAP also. Then it prescribes the criteria for selecting, changing, and disclosing accounting policies. So what accounting policies to be disclosed, selected, how this can be changed, and what is it that needs to be disclosed. What are the general principles? Let's look at first the general principles. So like in Indian GAAP also we have going concern, consistency, and prudence. So, that. So here also general principles are similar. So one is the going concern. So the principle is that the company is a going concern. If there are any indicators that the company may not be a going concern, then it has implications not only in the calculating the amount, but also the disclosures and the audit report thereon. Because it's a fundamental accounting assumption, that is what we have seen. Accrual basis of accounting, consistency, materiality, substance over form. So we need to look at the substance of the transaction over form. And I think Ind AS has, in quite a few places, Ind AS is saying about substance over form, and it has given guidance. Though of late, it is also getting into rule-based, which is as per the US GAAP is rule-based. Indian GAAP was completely principle-based, and hence there, there could be some contradiction. So, let me give you some examples to say, what could be the contradiction. So, for example, say for example, lease. Now, the lease standard gives extensive discussion around when there is a lease. So sometimes, so for example, if we have an asset, a company has given an asset on lease to another company for the useful life of the asset, then practically the asset is owned by the lessee, and it can go out of the books of the lessor, right? Or it has given a guidance around how do we de-recognize the financial liabilities. Whereas in Indian GAAP, such guidances are not there, and hence it is possible that we follow the form, then the substance. But however, this will get matured over the period. And disclosure of all accounting policies used. Repeating, Kemisha madam also mentioned about the regulators looking at it, and I also want to re-emphasize, please read the accounting policies of all your clients. Let it not be copy paste, because in copy paste there could be change. People may not look at it that way, so long as it is appropriate. So the actual practice and policy could be different, and that is not technically appropriate. Since going concern is one of the fundamental, I thought, let me give you one example of going concern, which I recently came across. So I thought, so this is for Vodafone Idea, March 22, SEBI results. it says material uncertainty related to going concern. Because as I am saying, what we discuss is going concern is, we need to evaluate going concern. Caro is also giving, Caro 2020 also has the procedures to be done around going concern. Auditing standard also says, Caro specifically says it's not a going concern evaluation, but evaluate based on the calculation of ratios, whether the company will be able to meet its obligation. So it's a short of going concern, but it is going towards going concern. Standard is already there, standard 570, auditing standard. We consider this as the fundamental accounting assumption and hence not given enough importance. However, with what has happened, COVID, pre-COVID, some corporates, suddenly could not meet their obligations, and hence this became a focused discussion during the with the auditors. In fact, if I go back in times, a few years back, discussing going concern was never considered to be not those charged with governance would not look at it in the right spirit few years back. But now with what has happened, last 5, 6, 7 years, I think it is accepted practice if we as auditors challenge the company on the going concern, have that discussion around our concerns and take those responses. Management is also looking at it as a positive way of responding to our discussions. So it says going concern Vodafone. So we draw attention to note 5 to the financial results, which describes the company's financial conditions and its debt obligations due for next 12 months. The company's financial performance has impacted its ability to generate cash flows that needs to settle, refinance its liabilities as they fall due. The company's ability to continue as a going concern is dependent on its ability to raise additional funds as required and successful negotiations with lenders for continued support and generation of cash flows from its operation that needs to settle its liability as they fall. Our conclusion is not modified. So there is the uncertainty. And so uncertainty is so much that the auditors is not able to conclude. And hence auditor has given this as an emphasis of matter in the paragraph, saying that these are the facts. And then it says note 5. So I thought, let me reproduce note 5. So it says the group has incurred loss for the year and its net worth stand as negative. So loss is there, negative is there. As at 31st March, the total debt of the group stands at so and so. An amount of rupees so and so has been classified from non-current borrowing to current borrowing of long-term debt for not meeting certain covenant under financial agreement. So, and there is a rating downgrade. So certain lenders have asked to increase interest rates, additional margin security against existing facilities. So there is a loss, number 1. Number 2, there is a negative net worth. Number 3, there is a huge debt. Number 4, company is not able to meet some covenants and hence otherwise it was a non-current borrowing, but which has become current because of non-meeting of all those loans. Correct. And it says, as the group has already availed moratorium in respect of AGR and deferred spectrum obligations as referred to in so, and raise funds from promoters. So it's a good fact that promoters, despite all this, promoters have put in money. The group's ability to going concern is dependent on raising additional funds as required. See, management is right. Successful negotiation with lender for continued support and generation of cash flows from operation that needs to settle its liabilities as they fall due. As of date, the group has met, very important, all its debt obligations. So promoters have funded, as of now, all debt applications have been met. And both these are a very good fact to say that, of course, the situation is not good, but it is not certain that it is not a going concern. It is not certain that it is a going concern. So pending the outcome of the above matters, these consolidated financial results have been prepared on a going concern basis. As I said, this is fundamental and hence it is important. The next is on consistency of accounting policies. So accounting policies, uh, should be applied consistently. It was easy under Indian GAAP. It is easy under Indian GAAP to change the accounting policy. However, under Ind AS, it is very difficult to change the accounting policy, and it says either if it is required by the standard, so which is Ind AS. So we have seen these new standards coming in, Ind AS 115, Ind AS 116, so revenue recognition, leasing new standard came in. So that was required by this, and hence there is a change. Or it says it results in providing reliable and more relevant information about effects of transactions or other events or conditions on company's financial position, performance, and cash flows. So it says if company believes that the change policy is more reflective of its business, it's more reflective of its balance sheet, so financial position, state of affairs, or its performance, then company can change. I think it becomes very difficult. Like in Indian GAAP, we don't have to give such reasons why there is a change. Company has decided to change the accounting policy, right? Now it says if there is a change, then what happens? Because this is the most painful, if I were to use that word, as far as the Ind AS. So that's why in most of such changes which is required by Ind AS, there is a transition provision. So in revenue recognition also 115, there was a transition provision, and there were some 2-3 options which were there for the company to decide which way company needs to go, whichever is the easier. Even in 116, it was there. Leasing, there were 2-3 options given. So there is a transition provision which is there. Correct. However, what happens if there is no transition provision, or what happens if the company feels that that is a better position to reflect its state of affairs and performance? Then one has to do retrospective applications. And this becomes, in my opinion, this is a very tedious way of implementing the change. And hence, whatever policy company adopts under Ind AS, one has to be very, very careful that this is the right policy to be adopted now and going forward, because any change is a tedious process. So any change, that means one has to go back and change all the periods presented. So for example, if it is any change where last year's financials are there, so all the last year's financials and the numbers needs to change as per this, and the difference will sit in the last year's opening balance sheet. So equity, and in the equity, if there are 3 years financials, then it will sit in the 3rd year. So all the period presented. So if I were to use the word all the periods presented, unless there is a specific exemption under, SEBI had given some exemption for the companies who had moved to Ind AS in the initial period. So those are the ones where that can be adopted. Otherwise, everything will have to be given under. The idea is, everybody wants a consistency. Everybody wants to evaluate the performance based on the consistency over the period. So frequent changes in accounting policy is difficult to measure the performance of the company. And it says what if it is not what if impracticable? So what if it is not possible? Very difficult to say, though the standard says because I've seen clients saying that it is impracticable because of the tedious or the calculations required. However, if it is genuine, so one has to go back in time. Suppose one has to restate last 3 years. In last 3 years, what could have been the judgments and estimate, because one can't change the conditions existing as on that date. One can do as per the Ind AS. So, for example, uh, we used to have in Indian GAAP, for example, we would only look at actual provision for debtor. So any sales on an actual basis, whereas Ind AS it says on a expected credit loss basis. So there is a difference. So when company moves from say Indian GAAP to Ind AS, then one can look at it as a condition and develop a model. But today, if the company were to change just the policy, that was to come into Ind AS as a first time adoption, those were the options. But now to develop a model or those existing as on the balance sheet date of the previous period could be, it is possible either information is not available or it is genuinely not practicable because company is not aware of what were the conditions as on that day, or that longer the period in the past, it is become more and more difficult of those judgments and estimates. So standard do give some this about, if change is not practicable, but as I said, it becomes a real challenge, and hence it is important that whichever policy company is following, that company, we advise company to follow it, read it carefully, because the change is going to be a challenging aspect. The next is on the materiality. Now, materiality is across, right? So materiality, we need to look at everything which is material. However, what it says that it is inappropriate to make or leave uncorrected immaterial departures from Ind AS to achieve a particular presentation of an entity's financial position, performance, or cash flows. So idea is that one has to look at materiality. But let me give you a couple of examples. One example, at least it strikes to me while talking. A lot of times companies want to say that I am debt free. So even if there is a small borrowing, right, company would want to say, so long as it can be considered as derecognition of a financial liability, or it can be adjusted against cash and bank balance because there is direct linkage, it's a different. But otherwise, one can't say that adjust against cash and bank balance or show that borrowing as a sundry creditor. It's a borrowing because to boast, even if the amount is not material, borrowing is a borrowing. So or that the company has done the factoring of their debtor, but it is with recourse. So if the factoring is done, that means the company has sold those debtors. But if the money is not received from the debtor, then ultimately responsibilities of the company. In which case, the debtor stands and there is a loan liability which is there. But if it is done without recourse, which is a securitization, we've seen, then it's actually the debtor or the loan book goes out of the book and there is no liability. So that's where I'm saying materiality is important, but it should not be done to achieve a particular presentation. The next is, what happens, because, we find that a lot of times there is no accounting policy which is available. The idea is that what do we do? Correct. So bottom line is, do it something which is logical. Though there is a guidance and we'll run through the guidance. Correct. But adopt something, the accounting the policy or the practice, the measurement and the disclosure, do it in a very logical way. So it says relevant to economic decision making needs of the user. Reliable, that it represents faithfully financial position, performance and cash flows. Reflect the substance of a transaction and events and conditions, not merely legal form. So it's not a legal form, because a lot of times company, we follow the legal form, the substance we forget. So idea is that what is the substance of a transaction should be represented, should be free from biases, prudent and complete in all material risk. So this is what is saying that if there is not there, but before coming to this, if there is any requirement, if there is anything similar which is there in other accounting standard, we should borrow from there. So we should if any other accounting standard is dealt with, then do it accordingly. Also look at the conceptual framework issued by institute for recognizing asset, liability, income, expenses. Or that if there is ISB or similar standard setting bodies, then follow, if there is any announcement, similar announcement which has been made by them, or that if there is any industry practice, to the extent it is not conflicting with any of the accounting standard, I think we should follow it accordingly. So idea is, as auditor, what we need to do, we need to ensure that accounting policies are in accordance with the accounting standard. It has been followed consistently. Number 2. Number 3 is it is disclosed. Number 4 is, if there is a change, then we have seen what is to be done. Mind you, if the transaction which has been done in the past and it is not material, then on the materiality we can still ignore. I'm saying materiality is fundamental. So we can say that company is doing something which was not material, but now company wants to do differently. Then it's not a change in accounting policy, because it was not material in the past. It is not material, and hence it is fine. But anything which is material, one has to go through this. And again repeating, make sure that you read the financial audit accounting policy. Don't do copy paste of the last year, and ensure that what the company does is in accordance with the auditing standard. So that's it from my side. If there are any questions, I would be happy to.
Sir, thank you so much, sir. Thank you so much for detailed and elaborated deliberation. Sir, I have 3-4 questions. If you permit, can I ask the same, sir?
Yeah. Is there? I can read the questions, or
No. I'm just. Sir, the first question is: can projections and estimates in a project report are to be signed by a chartered accountant?
Sorry.
Can projections and estimates in a project report be signed by a chartered accountant?
No. I don't think there is an auditing standard for the future financial statements, but we need not sign it, because ultimately we can help management as an expert, to develop those models, but we don't, as such, we don't sign it.
Yes.
So it's not an assurance that we give. We do it as an expert. So suppose if I'm valuing something, then I can say basis, and there are, as per the valuation standard, those disclaimers are there. But as such, we don't say assurance as auditor that this is how we have signed off. But we can do it based on as a regulatory framework. So if valuation of investment is done for the purpose of any transaction, and there is a regulatory requirement, then as per the regulatory requirement, one can sign up those reports, but not as an assurance.
Yes. Sir, company have an accounting policy disclosed in notes to accounts. that fixed assets purchased below rupees 20,000 are fully depreciated in the year. Fully depreciated in the year of addition. How to report such?
So it's a policy. One has to look at the materiality. Otherwise, even if it is 50,000, 1 lakh, depending on the size of the company, it is fine. The only control. So now the good fact about this is that it is depreciated fully. Otherwise, the issue is that if any asset which does not pass through fixed asset register, then the issue comes around the control. That how do you control something which has not passed through, so it is directly debited to profit and loss account. So long as it has gone from through the fixed asset, that means there is a control which can be exercised. And so long as it is not material, so even if the its useful life is say more than 1 year, it is fine. I'm perfectly all right.
Yes, sir. Sir, how to report the revaluation of investment in a subsidiary company when previously completely written off in the books, since the subsidiary has over time accumulated profits after acquisition?
Sorry, come again. So how do you
How to
revalue?
sir, the question is how to report the revaluation of investment in a subsidiary company when previously completely written off in the books, as since the subsidiary has over the time accumulated the profits after acquisition.
So then that to the extent of the cost, correct? Because subsidiary, I'm assuming subsidiary under Ind AS, it is accounted on a cost basis. To the extent of the cost, it can be written back. It can be written
Sir,
back.
what is yes.
But it can't be written back to the, it can't be revalued as revalued. It is a write back of the provision. So it is provided. So it is written back.
So one member is asking, while auditing the financial statements, what are your opinion to just give a gist to what accounting policies we just check at the time of the auditing of the financial statements or books of accounts, what we have to check as a accounting policy and estimates. And a gist if you can tell.
Sir, I'm not able to understand. In case of which?
Member is asking, while auditing, while auditing the books of accounts or financial statements, what accounting policies we need to check? As a gist, if you can tell.
No, okay. So one has to look at what is the accounting. First, one has to understand what is the accounting policy. So what is the business, right? Then what is the accounting policy of the company? So let me give you one example just to clear the doubt. So accounting policy is say accrual. Now accrual could be at what point of time it accrues. So suppose the company is say dealing in shares and securities. Now accrual can be two ways. One is on the trade date. So one is say I have done some trade on say 31st of March. I'll say I have done the trade. I'm accrual basis. I'm accounting. The other way of doing it is on a settlement basis. So this 31st March trade will get settled on say 2nd of April. And company can say I'll account it on a settlement basis. Now if the company is saying that I am accounting on a settlement basis, but it is actually accounting on a trade date basis, then there is a difference. So what I'm saying is we'll have to first look at what is the accounting policy. Then say that whether in case of say purchase and sale. So in case of sales, is the property in goods or the control over the item has it been passed as on 31st of March. Right. Now company will have some policy which will be as per say Incoterms. Is this policy being followed by company actually by recording the sales? So sales may have got recorded based on the invoice raised, but at a cutoff period, has it actually control has passed? So one has to, as I said, one has to look at it that way and then evaluate whether it is in line with number one, accounting policy as per this. So it is accepted accounting policy. And number two, it has been implemented accordingly.
Yes, yes. So these were the questions for this today's session, sir. Thank you so much for deliberation. And
Thank
on
you.
behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant, sir, once again I extend my heartiest thanks towards you for sparing your valuable time and acceding to our request on a very shorter notice and enlightening all of us on various activities while auditing.
Thank you. My pleasure. My pleasure. I would love to. I would love to have a feedback because it's all a one-way talking. So I do not know. So if there is a feedback mechanism, I would love to have so that I can upgrade myself.
It was wonderful deliberation. It was wonderful deliberation, sir. Thank you so much, sir. Thank you so much, sir.
Thank you. Thank you.
Thank you. Thank you. Thank you. Namaste.